Good afternoon. My name is David Jarvis, and I'm President, CEO, and founder of Corton Capital. Corton Capital is an asset management firm that specializes in traditional investments and alternative investments. Our goal is to create comprehensive portfolios for investors by marrying up both traditional and alternative investments for you. What follows next are a series of presentations and comments by various managers within the Corton family discussing the performance and successes that they've experienced with the funds that are carried within the Corton family. I hope you find it informative and we look forward to working with you. We are here to work with you and create comprehensive and interesting portfolios for you. Thank you very much.
And welcome to the Cormark-Corton Quantitative Fund podcast for the month ending in November. It's December 3rd as we're recording this. As usual, we'll start with the disclosures. I'm Mark Deriet. I'm an officer and director of Cormark Quantitative Analysis, Inc., or CQA. It's a wholly owned subsidiary of Cormark Quantitative Analysis, Inc., and CQA developed quantitative models that have been licensed to and implemented by Corton Capital. Corton is the investment fund manager and portfolio manager of the Cormark-Corton Quantitative Opportunities Fund and its underlying fund, Cormark-Corton Quantitative Opportunities Fund LP, each a related issuer of CSI and Corton. It's a mouthful. So let's get into our red light, green light, top-down indicators. And a number of these have flipped from yellow back to green, and we'll get into some of the details. So we were seeing a lot of areas correcting, and then at the end of the month, there was quite a big reversal that popped some of these back into the green camp. So, it looks like the charts in front of us will have this perhaps a year-end rally. We don't like to predict, but we like to follow these signals. And, big picture, we do think that the bull has a lot more time on its side, potentially, given the basket of indicators that we look at. We did think there would be a bigger pullback and a bit of a flush out, but that never happened, frankly. So this slide is the global equally weighted index of about 3,000 stocks. And it did start to slip below our short-term indicators here. The green line is a weekly trender, it's called, on Bloomberg's proprietary indicator, just a support level. Blue line is the 20-week or 100-day. These are kind of the first important lines in the sand for us. You can see that it broke below and quickly has started to reverse back above it. But the market has been treading water and kind of churning for a few months now after a big uptrend. This is the equally weighted S&P. It too has been going essentially sideways since peaking out around the summer. A lot of our breadth measures peaked out back then as well, but it did hold support and it's back testing the highs. The market cap weighted S&P never broke those lines. It threatened to near the end of the month in November, but then had this quick, pretty sharp reversal. And one simple indicator we look at that suggests there's time on our side for the bull market is this bottom clip. It's a weekly RSI indicator, it's called. It's just an oscillator that goes from 0 to 100, 0 being very weak, 100 very strong. And the way we interpret this is we want to embrace strength. We use a turn above 60, which happened in June, as a signal to buy, and below 40 as a sell. So we see we've marked in red circles below 40 and then above 60. So, it kind of keeps you out of trouble until it's in gear. And on average, we went all the way back to 1896 for the Dow and the S&P. And on average, those bull triggers, the green arrows, last 20 months. And given that it just happened in June, the bulls should have time on their side. We thought we'd zoom out. There's going to be a lot of prognosticators, suggesting to call year-end targets for 2026. And rather than do that, we like to be open to a wide range of outcomes. So we just did a simple regression off the 2009 lows to show that we have indeed been in a secular bull market. And the table on the left shows the history. There's not a lot of data points there, but they tend to last around 18 to 20 years. The CAGR during these secular bulls have averaged 13%, and that differs quite a bit from a bear. They last on average 15 years. The CAGR is only 3. So if we get out our ruler and do a regression, we see that at the end of 2026, again, a wide range of outcomes, the bottom end of the range, 2 deviations versus the mean to the downside, is 6,000, and to the upside is 8,000. That's obviously a wide range. The midpoint is 6,900, right around where we are now, frankly. But if we, zoom out and go into the future, 2030, we recently came across a podcast where Ed Yardeni was being interviewed, and he's been a major bull, calling this the Roaring 2020s. He has a target of 10,000 by the end of 2030. And lo and behold, if you do a regression, the midpoint is actually 10,700. So, we just get out our ruler and have the same outcome as that famous strategist in the US. And the secular bull, really arguably isn't due to end until around, the mid 2030s. So if we extend that out, it's 18,600. So, these are obviously pie in the sky numbers, but the point is we're in this long-term bull where we keep staying within these bands of the regression, and until proven otherwise, that's where the bull flushes out. And importantly, the CAGR of these lines also lines up with 13%. You can see 2030, 13.2%, 2035, 12.96%, right in line with the typical secular bull. We look back here at the bull from the start of the low of 1974 and all the way to 2000, and that CAGR was also 13%, and we ended right near the top of the band in 2000 when we had that blow-off top for the NASDAQ. The prior bull to that, 1942, was the major low, and it ended in 1968. This didn't get to the upper end of the band. There wasn't really a blow-off top back then. The Nifty 50 started to deteriorate earlier, but that CAGR was 10.5%. And one of the drivers of this long-term bull, we've argued for many years, is demographics. So the red line here shows the number of prime workforce age cohort, that's 25 to 54, for the boomers. That peaked in 2000 and started in 1980, right in line with the prior secular bull. The blue line shows millennials, and that's not due to peak until 2035. So back to the near term, you've had your kind of history lesson of secular bulls. We did get close to flashing a warning sign from this Brett signal, but it didn't quite trigger. So the red bars show for the Russell 3000, the broadest group of stocks that we look at, how many are making 52-week lows. And we use a number north of 10%. We got to just over 8% recently as a big warning sign. So the last time that happened, they're all circled in yellow, was November of 2021, and the market peaked out in Jan 22. And then you eventually get this washout where there's blood in the streets after a big bear, and when that red bar exceeds 30%, that's generally a time to buy. So we didn't get the trigger, thankfully. If we did, on average, the market peaks out 3 months later. So this is on our radar, but thankfully it didn't trigger. And the green bars, the new highs, are starting to expand again. Another thing that suggests there's time on the side for the bulls is this line here that shows for the Russell 3000, how many stocks are above their 200-day moving average at any given time. So it's just a simple way of defining an uptrend. In April of this year, that got to sub 15%. Again, blood in the streets. And what we did here is we looked at kind of the duration between these washout periods as denoted by these arrows. So if we go below 15%, then get back above 60, which is a kind of all clear signal, the average gap between these lines in duration is 40 months, the quickest being 15 months. And given that we just had it in April, we shouldn't necessarily be looking over our shoulder for a major bear market anytime soon. On a short-term basis, the left shows a very tactical indicator, the percent of stocks above their 20-day for the S&P. We were looking for this to have a bit of a flush. When you get below 20%, that's been a decent buy the dips indicator, and it just frankly didn't get there. We got to around 30%. On average, this goes sub 20% 4 times a year, and it hasn't happened since April. So, the odds were with us, but it didn't happen, and it's now reaccelerated. And then on the right shows the percent above the 50-day, just a bit longer term than the 20 and shorter than the 200. That peaked in July. So we have had a correction underneath the hood since then, and it got to just over 30%, and now it's accelerated back to above 60. So the glass is half full. A number of indicators also settling back down. So this is volatility, but not only for stocks, but it combines bonds and currencies as well. This was starting to perk up, which is a bad thing. Now it's back to the highs. Credit spreads also started to percolate, and now they're starting to tighten. So a yellow light back to green. The red line here shows a basket of credit spreads, but it's inverted. And the blue line is the equity market. And they have started to diverge a bit, and now they're recoupling. So again, a yellow light turned back to green. Commodities are emerging from a pretty big base, basically a sideways pattern that has lasted almost 3 years, and now they're resolving to the upside. Obviously, gold has been a big driver. And we were looking for gold to come back to this blue line where I've shown the red arrows. It's done on every correction. The blue line is caught up to the price, which is still a distinct possibility. So, maybe gold has to spend some more time backing and filling. Silver is the new kid on the block, if you will. It's making all-time highs, and it looks like gold did a couple of years ago. Silver, the next big line upside is 63, and longer term, you can see a target towards 100. Copper also is very strong. We don't have the chart to show you, but that's breaking out to the upside as well. So commodities are in gear. This is a basket of risky versus safe currencies, and this is on a yellow light still. It's correcting. The good news is that the US dollar, one of the safest currencies out there, along with Swiss franc, has started to roll back over and failing below key resistance. So that should help the commodity complex. And in general, when the dollar goes down, that's a risk-on trade. Rates are giving a yellow light. So here in blue, we have the 2-year bond yield, and the Fed funds is in red. And you can see the market dictates the rate structure, not the Fed. And here we show, I think we've spoken about this before, when you start a rate cutting cycle, there's risk of a recession. They're cutting for a reason. Bond yields are going down for a reason because the economy is slowing. The demand for capital is ebbing. So 4 out of the 8 rate cutting cycles, you've had a recession. And the outcome for the S&P is obviously very different if you have a recession or not. We show here the average recession versus non-recessionary outcome for the S&P. It's the polar opposite. So the good news is we don't see enough evidence of a recession. The blue line here is called the Fed Weekly Economic Index. It has mostly what they call hard data, things like gasoline sales, electricity usage, retail sales, et cetera. And this was continuing to appear, the data during the government shutdown. It's done by the Fed. So the good news is that has not plummeted. The other 2 lines on this chart are surveys of how people feel. And that would have suggested a recession in the middle of 2022, and we're still waiting for Godot. So again, the blue line is solid and no recession yet. We have labor market indicators also that we've shown before. I don't have it in the package today, that are slowing but not collapsing. So we don't see enough evidence of a recession yet. Another yellow light comes from our basket of risk trades. This is called our Baker's Dozen. You can see it has been correcting, not confirming highs in the S&P. And one important one is the price of Bitcoin relative to gold, which on the right is the red line, and the same with the left. And the black line is the triple Qs, the NASDAQ 100. So you can see that, especially in the right top chart there, the ratio of Bitcoin to gold has been going down as the triple Qs have been going kind of sideways. So what we look at is the bottom chart, the rolling 150-day correlation between the two lines, and that has turned negative. So this is definitely on our radar. And on average, though, the triple Qs don't peak out for roughly another 6 months. So maybe some time on our side as well there. But we would like to see Bitcoin, the ultra risk trade start to gather itself and resume its uptrend. Sector rotation is also on a yellow light. This is a ratio of cyclical areas, discretionary industrials and tech versus defensive areas, staples, healthcare, and utes. And it too has been correcting, not confirming the strength in the S&P. In terms of our sun range chart, so this is breadth by sector in North America. Gold still at the top. The stocks have corrected. We thought they'd pull back more, frankly, but they're starting to reaccelerate. Energy has had a very positive inflection. If we look at the table, this is 1 is the best and 12 is the worst. Energy was quite weak until the last couple of months here. Now it's 2 out of 12 on our long-term score. And healthcare has had a big improvement as well, driven by the US. But some of the cyclical areas, discretionary is deteriorating, and tech is actually down here, close to neutral on a long term, but below neutral on a short-term basis. So turning to our fund, so our net exposure, we've increased it somewhat, sort of heading back toward neutral. We were quite defensive in November, and frankly, that was starting to work in our favor, and then the end of the month reversed all that benefit, frankly. So we've increased our net exposure. We're 88%. We still have shorts. There are stocks that are triggering our short screen. So we have 25% shorts. Our beta is 0.7. It was as low as 0.3, I believe, at the start of November. We have moved up cap. We have more large caps, 55%, resulting in a lower active share of 62%. We'll talk about what that means in a second. And we've got a bit of a barbell, if you will. We've got a number of defensive stocks like utes and telcos and staples, but we've added more resources, both base metals and precious metals, and we're about neutral the energy sector. This is what we've spoken about before, active share. So the average fund in Canada has a 50% active share, meaning that the red circles would be the fund and the gray would be the index. And it's like the Venn diagram, how much do you overlap? In general, we're aiming for about 75% active share. We have been as high as 90 plus, and again, we're currently 62%. So given, there's sort of a bit heightened risks in the market in the near-term basis from our yellow lights still, we just want to reduce the liquidity risk in the fund. These are some screens that you can go through at your leisure after where we pull our ideas from, and the sun rain chart at the stock level. So we employ fresh money ideas in the upper left improving camp, and we look for fresh shorts in the weakening camp. Here's a few trades we've done recently. We have added to materials recently, some stocks breaking out here, Champion Iron Ore, Arrow Copper, and Patriot Battery Metals. So we're looking for these, kind of clean breakouts on the charts. A high quality stock that we've added recently is Intact Financial. The chart is starting to improve. It's one of the highest quality stocks out there. It's a top decile on our quality factor. Suncor is a value buy that we recently added. The stock's breaking out of a big base, and its valuation versus history is quite attractive. A short on the value side is ATRL, Atkins. It's the old SNC Lavalin. This is the chart relative to the TSX. You can see it's broken a big uptrend, and the valuation is still high. It's dear at 8 out of 10. 10 would be very expensive. So the month was a slight gain of 0.3% for the fund. That's the estimate. We lagged the index. We came into the month too defensive, as we said, and it was working in our favor. We had some inverse shorts on the market, and you can see one of them is PSQ, which turned out to unfortunately add negative alpha for the month. That's the inverse of the NASDAQ 100. The biggest contributors were Extendicare, Ray, and Quebecor, and the laggards, that's PSQ, and then NXC is a uranium stock, and TransAlta as a utility. Overall, we're pleased with the performance at 20.7%. And we would note that we're lagging a little bit now, the market, but our beta since inception is only 0.61. So, we try to deliver market type returns or better with much lower volatility. So very early days, obviously, it's only 7 months into the process, but that's where we stand so far. So if you're interested in the fund, please reach out to myself or David Jarvis, our partner at Corton Capital, and our details are in front of you. Take care.